Investors, we skipped last week's video because the Oak Harvest Financial Group's investment team was busy producing what should be the first in a series of monthly investment videos covering our long-short hedged equity strategy, our moves in that strategy, and its outcomes. This is a very unique alternative growth equity strategy. If you want to know more information, search oakharvestfunds.com. Also, starting in September, we're probably going to change some of our video editing for Stock Talk so Eric can spend more time on other Oak Harvest video productions. Expect our content to remain the same, but the look and feel might change just a bit. Investors, it's been an incredible 4 months, with a V-bottom rally in stocks since peak market fears over the economic uncertainty caused by the Liberation Day tariff spreadsheet chaos. We're still in the earnings reporting window for second quarter reports, so our team is trying to sort out the good from the bad and figure out what and when we might want to make changes to our clients' holdings for the remainder of the year in 2026 as well. I'm getting right to the point. The last 2 weeks in the markets have even surprised me, albeit in a good way. We had the V-bottom in stocks from mid to late April, well before the historic rally took hold, and while many others were talking about doom and crashes. However, I had expected a summer stall and a pullback in stocks of a little over -5%, call that back down to 6,100, 6,150. And while that is still possible, it's looking a little less likely that we drop back to those levels. Why? Here's what I'm seeing. Over 2025, our team has discussed and compared the current economic cycle, uncertainty, and outcomes to a couple of other time periods. President Trump in his second term, we've discussed Trump 2.0 versus 1.0. He came out and threw us a curveball this year, focusing on frictionary economic policies such as tariffs, trade, deportations, and all things that raise costs and slow growth. And then, secondly, focused more recently on investor-friendly policies like lower taxes, lower regulation, and targeted government spending. In 2025, he pretty much flipped the script on his first term in 2017 and 18. The second time period we've repeatedly pointed out is the late 90s .com internet infrastructure build-out, Y2K period versus our current AI infrastructure and Federal Reserve cycle. Specifically, back then, minus 21% S&P 500 drop caused by long-term capital markets blowing up in October 1998, early mid to .com build-out. With the minus 21% S&P 500 drop early in 2025, caused by Trump's tariffs and Liberation Day, this is appearing more and more likely to be mid-AI cycle, not late. Take a look at the updated overlay of the S&P 500 back then and now. We're still mirroring the same pattern almost to the day and week. Looking back in time, the percent drop during the first stall after the long-term capital management V-bottom 4 months out was only minus 3.5% in the S&P 500. If one uses that as a drop from our high on 7/31, one gets 6202 on the cash S&P 500. The low print for the second half of 2025 so far has been right at 6200, 6210. And on August 1st, the first day of August, it was 6212 so far, almost exactly 3.5 off the top. Investors, given what I'm seeing in earnings, sentiment, seasonality, and cycles, institutional positioning, and volatility markets, as well as Fed interest rate cuts to come, I think that it's likely that the fourth quarter of 2025 and the first half of 2026 will bring higher stock markets than most think. The pattern of the dollar index looks remarkably similar to back then and now, with most people now bearish on the DXY, just as the charts say they should be otherwise. Many investors are still worried about interest rates. Many are coming up with wild theories that foreign selling will cause a massive bond market sell-off, sending long-term interest rates much higher. Investors, these theories have been out there for years now, and while foreign holders have been net sellers for years, it's unlikely that it's made much difference from overall yields. More likely, the higher secular inflation here in the US from overspending and money supply is causing higher interest rates, not foreign sellers. Investors, additionally, think about most baby boomers who are near or in retirement and still control close to 75% of the wealth in the US. I bet you they would relish higher rates to stash some of their wealth after earning next to nothing net in bonds for the last 8 to 10 years. Investors, volatility looks to be in a downtrend, both stock volatility and probably more importantly, bond volatility. Both the realized and implied components of cost of hedging stocks 2 to 6 months out are almost 2 to 3 times as much as expensive as actual realized volatility. Looking over in the bond market, the MOVE index, which measures bond market volatility, has now broken below 50. And regardless of what you hear on TV, it's declining, not rising. This has historically been a great thing for uptrends in stocks over months and quarters. Take a look at the chart of the MOVE index. We've talked about this one in the past. Remember that lower bond volatility is the key to leverage players buying more assets, as treasury bonds are the lowest risk collateral in the financial markets. Think investors, we're at marginal new all-time highs, up about 5% above previous all-time highs in stocks, and the Fed is paused. Think about that. Think about all the bear calls for a market collapse as the Fed produced its balance sheet, and we are near 6,350, 6,400 on the cash S&P 500. As I write this, the Fed's balance sheet has shrunk by $2.6 trillion since QT began. Investors, we're in a bull market. Against the most recent calls for an inflationary spiral caused by tariffs, we're still in a bull market. Short-term volatility has actually collapsed, and that's without the Fed cutting interest rates. Realized volatility is around 78, spot VIX index is around 15, but every time that gets to around 21, the sellers come out in those markets and buyers flood in to buy stocks. The cost of forward hedging stocks is very high relative to actual volatility. After a slowdown in the pace of gains for the next few months, what's likely to lead? I'd look no further than what led during the second half of the dot-com run. Technology, financials, housing stocks, and even eventually energy stocks. Here's the historic overlay of the SOX Semiconductor Index during dot-com and currently for those who are still watching. If you believe in this model, sure, a sideways summer is a very keen possibility as inventory and stock gains get digested. Then, followed by a big pickup into the fourth quarter of 2025 and 2026 as orders and stock price performance go up. You might not have believed history is repeating, but someone does, or the market overall does. Yes, investors, the pattern remains bullish, and up and to the right is good. New all-time highs are not bearish historically. While breadth is narrowing a bit over the last 4 to 6 weeks, expect it to widen materially if and when the Fed cuts interest rates. Maybe be prepared in advance of the fourth quarter of 2025 to hear about the chase for performance into year-end before it takes place. Investors, even small cap stocks, tend to work and lead for a while in most periods when the Fed starts cutting rates because many institutions are behind their benchmarks, like they are this year. I titled this video, V-Bottoms, Moving On Up, because while I continue to think the pace of the gains slow over the next 2 months, I also believe that on the other side, come late September or early October, most of those S&P 500 targets for year-end and for 2026 are likely moving on up higher, not lower, for the fourth quarter and beyond. Investors, regardless of the path for the economy and the financial markets over the next few months, the investment team at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend and know that the Oak Harvest team here is doing what we can to plan for you and your family's future, regardless of what stage you're at in your career or in your retirement.